Beginner's Guide to Mortgages, complete edition with FHA loan types, credit scores, DTI and more. A mortgage is a loan used to buy a house. You agree to repay the loan with interest over time, usually 15 to 30 years. The home serves as collateral, which means the lender can take it back if you don't pay through foreclosure. Best for first-time buyers, people with lower credit scores or limited savings. Minimum down payment, 3.5% with a 580-plus credit score. Mortgage insurance required upfront and monthly MIP. Loan limits, set by county. Credit score, 580-plus or 500 with 10% down. Used for most residential purchases, 1 to 4 units. Simple structure with low down payment. Great for first-time buyers. Combines purchase and rehab into one loan. 2 versions, limited, up to $35,000 in repairs, standard for major renovations, slower closing but ideal for fixer-uppers. For borrowers who already have an FHA loan, fast process, no appraisal or income verification, lowers rate or term, no cash out allowed, lets you tap home equity as cash, requires full documentation and appraisal, ideal for consolidating debt or funding projects, finances energy efficiency upgrades, adds to the loan with no extra down payment, must meet efficiency standards. For homeowners age 62 and older, converts equity into income with no monthly payments, heirs inherit the home minus the outstanding balance. Pre-qualification versus pre-approval. Quick estimate, no documents required, not strong enough for serious offers. Full documentation reviewed, shows sellers you're a serious buyer. Essential before house hunting. Required documents, last 2 W-2 forms, 2 recent pay stubs, 2 bank statements, government-issued ID, credit check authorization, tax returns for the last 2 years, current profit and loss statement, 1099 forms, business license if applicable, bank statements. DTI measures how much of your gross monthly income goes toward debt, including the future mortgage. Add all monthly debts, credit cards, car loans, student loans, future mortgage, etc., and divide by gross monthly income. Example, monthly debts, $3,000, gross monthly income, $6,000, DTI equals 50%. Why it matters. Lenders want DTI under control so you can pay comfortably. FHA allows DTI up to 43% to 50% depending on credit. Conventional loans prefer 36% to 43%. Lower DTI equals higher approval odds and better terms. Your credit score shows lenders how risky you are. It influences approval or denial. Interest rate, higher score equals lower rate. Down payment options. Whether you pay PMI and for how long. Loan types you qualify for, FHA versus conventional. 740 to 850, excellent. 700 to 739, good. 660 to 699, fair. 580 to 659, poor. Below 580, very poor. FHA may still work. Pay down revolving debt, don't open new credit lines, check your credit report for errors, pay every bill on time. FHA 580 or higher or 500 with 10% down, conventional 620 or higher. VA no official minimum but typically 620 to 640, USDA usually 640 or higher. Put 20% down on a conventional loan. Use an 80-10-10 piggyback loan. Consider lender-paid MI, LPMI. Refinance once you reach 20% equity. Buy in appreciating markets and add value through renovations.